This is Ethan Heisler. Welcome to another edition of Just a Bank Minute. There's been a lot of speculation in the financial world about negative interest rates, which literally means that the fixed income investor will receive a negative return. There is growing concern about this happening here the way it already has in Europe and Japan, but there is a key technicality that's standing in the way, namely the fact that the Fed cannot charge a negative interest rate on bank excess reserves. Now, in the unlikely hypothetical situation that we wake up one day with negative rates, I do think regional community banks will be under more earnings pressure than larger banks because they depend on their net interest income for a greater share of their earnings. The largest banks are most exposed to earning negative rates because they hold higher balances of excess reserves and treasuries compared to smaller regional banks, as I show here in this graph. For the record, though, the last quarter of the U.S. banks in total earned under $7 billion in interest on excess reserves, or about 2% of total interest income. So even if, say, rates went from 1.8% to 0%, or even minus 1%, I do not think it will cause much of a dent to their earnings. I think, however, the bigger risk for the banks is on the liability side of their balance sheets, especially for banks that are retail funded, as I show in this second graph. Retail deposits are not generally going under 0%. You have nothing to worry about owing your bank money for your deposits. Not yet. But you probably can look forward to going back to earning nothing again for savings like we did before. Again, KBRA puts very low risk on this hypothetical, or that it would result in worsening creditworthiness. You can read more about this topic in my recent piece, Banking in Fear of NIRP. I am Ethan Heisler, and you have been watching another edition of Just a Bank Minute.